Good morning, everybody. Hope you're having a good Tuesday. The sun is starting to come out. It's still overcast, but at least it's starting to warm up a little bit here. So that's very nice. We're just going to give a minute for people to kind of trickle in. This was a much more popular webinar than we expected. So we're happy to have everyone tuning in, and this will be recorded for to go on our website. And so if you don't have the time to watch all of it now, you can watch it later, or you could rewatch it if you'd like. So basically what we're going to do is talk about a subject that's been kind of researched a lot over the last 20 to 30 years. And it's something I think on the mind of every person who's in retirement or close to retirement, and that is talking about portfolio withdrawal rates in retirement, right? What's a sustainable withdrawal rate that you can take from your portfolio and not have a fear that, oh my gosh, I'm going to run out of money, too soon. And so that's what this webinar is all about. And one caveat we'll say at the beginning is there is no perfect answer for this. And why is that? It's because there's always uncertainty around different parts of retirement. How long are you going to live? What's the market going to look like? What's your asset allocation going to be? Is it going to change over time? So all those things impact a sustainable withdrawal rate. So the idea here is to give you a framework, right, to view your retirement income strategy through, so you can have more confidence in it. And of course, I think working alongside 4J Wealth can also greatly enhance not only your peace of mind around the strategy, but your actual, the dollars that you're able to take out or leave behind to your family. So we're going to go ahead and get started here. Just one quick housekeeping item. If you have questions, if you could click on the Q&A box at the bottom of your screen, type in those questions. We have the whole team here on the webinar today. So Jeff is on, Jamie's on, Jen's on, and Sandra's on. So we're really excited to have everyone on together with with a lot of our clients. And then if you wouldn't mind, just to make sure all the audio visual is working well, if you could just raise your hand. There should be a hand raise button to let me know that you can hear my voice, see my face, and also see the screen. Looks like we should be good there. So excellent. All right, so we'll go ahead and get started. So the first thing to note is obviously this is for informational purposes only. If you'd like to discuss your specific approach or retirement planning strategy, talk to us directly or another advisor you're working with. As you know, we have to look back historically as part of this research. And so there isn't, a guarantee that the future is going to play out exactly like the past. So again, informational purposes only. And, if you're not a client of 4J Wealth, this is in no way deemed to be, advice specific to you. So here's what we're going to cover today. First, we're going to talk about kind of the framework and one of the things that's not intuitive to a lot of people when they're withdrawing money from their portfolio. And that's something called sequence of return risk. And we're going to illustrate that through an actual example. Then we're going to talk about historical withdrawal rates in different economic regimes, different time periods. We'll look at the minimum and maximum historical withdrawal rates, how asset allocation affects sustainable withdrawal rates. And then we'll look at a number of what we call more dynamic or flexible withdrawal rate strategies. And we can show you kind of the puts and takes of those different strategies and the effects they have on how much you draw from the portfolio, not only initially, but over the life of your retirement, and what's likely to be the remaining balance at the end of life. And then we'll also just touch on briefly kind of the tax effects on withdrawal rates, and just being aware that when we're looking at these withdrawal rates, it usually does also have to cover whatever the tax liability is from that withdrawal. So For most of you, you remember we're in the accumulation phase, right? So during the accumulation phase, the sequence of returns of your portfolio in the market, they play very little role in the terminal value of your portfolio. And here's a good example. These are the actual returns, price returns of the S&P 500 from 2000 through roughly 2017. And you can see here, 2000 was the height of the tech bubble, so the 3 subsequent years were negative returns for the market. And then here you have 2008. So this is probably one of the worst time periods to retire. And then here you have the exact same returns, except they're flipped. So you have 2017 first, so a good sequence of returns early on, and then the bad stuff happening later on. So it's literally a mirror image of each other. So same average return rate of just shy of 5% per year. And you can see here the exact same ending value. So whether the returns were bad at the beginning and then were good at the end, or good at the beginning and then turned bad at the end, the overall value you had at the end was the same. Now, if you were contributing money along the way, this would have been actually having negative returns early on would have helped you. Okay, but the big point here is that the sequence of the returns have no impact on the value after 18 years. Okay, even though they're in totally different orders. Now, let's look at the other side. So this is the distribution phase. So during the distribution phase, the sequence of returns are a huge factor in determining the longevity of your portfolio. And the correct starting withdrawal rate depends on 3 variables. It's going to depend on what was your overall asset allocation of the portfolio, what was the market environment that prevailed over the retiree's time horizon, and the length of the retirement. So here, look how different a story this shows. So here, the client is pulling out $25,000 or 5% of the initial portfolio value, but then they're not increasing it. They're just leaving that amount the same over the course of their entire retirement. If they retired in 2000, right, they had very poor returns early on. And what happened is their portfolio value declined, plus they took money out to the point where it was never able to recover even after subsequent years of good returns. So after 18 years, even though the average return of the market was the same in either scenario, they have a balance of only 20,000 in this scenario. Whereas here, if the good returns happened early on in retirement, look up, their balance was 20 times, 30 times larger. It's kind of incredible, right? And so this is the difference between your being in the accumulation phase and the distribution phase. And these are actual, now, again, this is a little bit extreme because it's assuming 100% equity portfolio, right? All in US stocks and taking out 5% in the first year. But nevertheless, I think it illustrates the point that it's a very different game you're playing when you're pulling money out of your portfolio versus when you're just plowing it in every year. Okay. So many of you have probably heard of the 4% rule or 4% rule of thumb. It basically goes back to originally 1994 and then 1998 when some research was being done by financial planners and professors. But basically what I want you to understand is what it is, okay? So the 4% rule does not mean you take 4% of your portfolio every single year. What it means is you take 4% of your portfolio balance, okay, in the first year, which in this case, just as a case in point so you can understand, 4%, you have 500,000, you're taking 20,000 out in the first year. And then every subsequent year, you're looking at what was inflation over the course of that first year. And then you're increasing your withdrawal rate for the following year by inflation. So inflation was 2.5% the first year. Second year, you're taking out 20,500. And you're taking that amount, and you're adding whatever inflation was in the second year, and that's what you're taking out in the third year. And this approach, the 4% rule approach, is considered to be a fixed real meaning inflation adjusted spending approach. Okay, so in all of the examples we're going to look at with the fixed real rule, this 20,000, right, or the 4%, and then the CPI adjustments every year, that goes indefinitely through the end of life. So if you live 40 years, it's happening for 40 years. It never stops. Okay, so it's extremely rigid, which from a retiree's perspective can be nice because it's kind of like you're getting a paycheck in retirement, similar to when you were working. But the downside of it is the lack of flexibility. The reality is you're taking a set amount of money and increasing it every year from a source, right, from your portfolio, which is inherently subject to ups and downs, volatility. So you're taking a constant stream of income from something that inherently is not constant. And that's really, that's the basis of sequence of return risk, is it's that mismatch. And so all of the research that we're going to talk about here today is about really understanding what it looks like over time periods, but then how can you kind of enhance your flexibility, depending on what your goals are. So I don't mean to make this kind of too boring, but we do have to go through some textbook kind of terminology here. So the first term that we want to understand is your starting safe withdrawal rate, okay? That is the withdrawal rate, which results in portfolio success, a success rate 90+% of the time over a defined time period, which in this case, for most studies, is going to be 30 years, okay? So that's a pretty healthy retirement. At 65, it's taking you to 95, okay? A fixed real withdrawal method, that's exactly what I just talked about. That's the 4% rule. So you withdraw a set amount of money each year, indexed for inflation to maintain constant real income. Real means adjusted for inflation. So we'd like to call this the paycheck equivalent throughout retirement, with a paycheck equivalent method. And then here's some kind of alternative methods that we're going to look at as well, and that more recent research has been done on. The forego inflation method. So that's the same exact thing as the fixed real method, except that you don't give yourself an upward inflation adjustment in years where the portfolio declines in value, okay? The RMD method, or requirement of distribution method, a lot of you are probably familiar with that because that's what you have to take from your IRAs. But basically there you're withdrawing an increasing percentage of your portfolio each year because it's your portfolio value divided by your life expectancy. Number 3 is the guardrails method. So you can think of it like, on a road or a highway, you have a guardrail on the left, guardrail on the right, guardrail at the top, guardrail at the bottom in this case, but it sets upper and lower boundaries on withdrawal amounts based on portfolio performance. And this is, I think, where kind of the rubber meets the road. If you can have an approach that at least takes into account the fact that when times are good, you can probably pull more, but when times are not good, you probably want to err on the side of caution and pull less because, right, you want your spending to be somewhat reflective of the engine that's producing the income for that spending, which is your portfolio. Then there's the 10% reduction method. That is it's again a fixed real withdrawal method, but adjust withdrawals downward by 10% and the year following a year in which the portfolio declined in value. And then lastly, the inflation haircut method. That basically says you're going to take the same thing as the fixed real withdrawal method, except rather than increase your income each year by the full amount of CPI, you're going to take it up by CPI minus 1% or minus 0.5%. In the studies we're going to look at, it's CPI minus 1%. And there's a good amount of research supporting that, because what has been shown to happen is when retirees kind of first set out in retirement, the first 10 years, 15 years, it's called the go-go years. They're doing a lot of travel. They're really kind of enjoying their time in retirement. They're active. But in the latter half of retirement, people actually do tend to spend less. Even though healthcare costs go up, overall spending does actually decline. Total return. So the method that's being used here to withdraw money from the portfolio is not just pulling the income from the portfolio. If it's pulling the income from the portfolio, and then if there's anything else that needs to be taken, it's selling off some of the capital, right? Could be from capital gains or just selling off positions to generate capital in order to fund those withdrawals. So it's a combination of income and capital consumption. And then another thing we want to understand is something called standard deviation. Okay, and I'll kind of brief these again when we get to this, because I know it's hard to remember all these, but we just wanted to give you a primer. So the standard deviation is the volatility of the withdrawal amounts on a year-to-year basis. So just as a case in point, if we're looking at the fixed real withdrawal method, there's no volatility around the withdrawal amounts, right? You know from the get-go exactly what you're going to take out every single year throughout retirement. And so there's no movement around that. It's fixed. Whereas something like the guardrails method, that's going to have a lot more volatility around the withdrawal amounts, because it's a function of how the portfolio is performing as to what you're going to take out. Okay, so here there was a study that was done where they looked at monthly total return data going all the way back to 1871 through December 1st of 16. And they were looking at return data for stocks. It was the S&P 500, so including capital appreciation and dividends. And then on the fixed income side, it was 10-year treasury bonds. So it was just looking at those two asset classes. It looked at 4 different time horizons. And I think this is interesting. A lot of people don't retire and expect to live 40 plus years beyond that point, but people are retiring earlier now. People are living longer. So I think it is helpful to have a framework. So 30 years in this case is the lowest, and 60 is the highest time horizon. Other assumptions before we get into the table are this is important. The final asset value target was set to 0 or greater than 0, meaning as long as the portfolio over these time periods did not go negative, it was deemed to be a success. Okay. And the Monte Carlo analysis was used to randomize the returns and simulate as many possible simulations as possible. And then up here, you can see the method that's used is that fixed real withdrawal rate. Okay. And there's flaws to it, but for this purpose, for the purposes of this chart, I think it's still instructive, where these are the percent withdrawal rate you take out of the initial portfolio value, and then you adjust it for CPI every single year thereafter. Okay. So what you can see, pretty clearly is that some portion of stock allocation, okay, if you're looking out 30 to 60 years, really 50% or more is pretty important. Okay, and it's pretty important because stocks have the greatest track record of outperforming inflation over long periods of time. Furthermore, you'll notice that even on the much longer time frames of 40, 50, 60 years, if you're able to start your withdrawal rate at 3 to even 3.5, really 3 to 3.25%. So what, just putting dollars to that, if you have $1 million in your portfolio and you really want it to last well beyond 30 years, and you have 75% of the portfolio in stocks, this is saying that you could comfortably take $30,000 in year 1 and then increase that for CPI each subsequent year. And based on this historical data, your portfolio might go down in value. It's not saying where it will end, but it's saying that it would be successful. Okay. If we go up to the 4% rule, you can see it's still pretty good, right? Over that 30-year time frame, it's very good, but it's not foolproof. Okay. So there are situations, even under 30 years, where if you're looking here, a 50-50 portfolio, 95% of the time it works, but there is that 5% chance that it doesn't work. Now, if you go beyond 30 years into 40, it actually does, it's still good, but it really does slip materially. So again, the chances that somebody, as they go throughout retirement, is not going to have adjust spending or withdrawals in the portfolio at all, based on what's happening in the world, what's happening in life, is a little bit unrealistic to us, and I think unrealistic to a lot of the researchers. So keep that in mind, that this is probably a little bit conservative in that it's assuming, total, 0 deviation from the plan over 30, 40 years. Okay. What is interesting is over these longer time frames, okay, and this is important, having too much in bonds, right, was not a good strategy. It doesn't mean that it would definitely not work, but it means that you're flirting with real trouble and real possibility of failure over even a 30-year time frame. Anything above 30, it's very risky. So something to keep in mind. I thought this was an interesting chart because it just shows such a wide range of withdrawal rates, but then also one of the few studies that really went out a long time period. Okay. So this table here looks at data from, it's a little bit different. It's still the S&P 500, but it's looking not at treasury bonds, it's looking at investment grade corporate bonds. So slightly higher level of volatility, slightly higher return. And the reason we wanted to highlight this is because this shows 30 years as the maximum amount, right? The maximum time horizon, and it actually shows 25, 20, and 15 years. And you can see based on the allocation, what were the chances of success based on the initial withdrawal rate. And one interesting thing to note that you would not know by just looking at the last slide was that over shorter retirement time horizons, such as 15 years, 10, 15 years, the allocation to equities was not nearly as important to sustain the withdrawal rate. In addition, the amount that you could withdraw, and this isn't shown here, but this is shown in a different study, the amount you could withdraw over a shorter time frame if you had a predominantly fixed income portfolio was you could pull a higher initial withdrawal rate relative to something that's more heavier in stock allocations. Okay, so the historical range of successful withdrawal rates. This looks at rolling 30-year periods from 1927 ending in 1992. So 1927 to 1957, 1928 to 1958, and so on and so forth, 30-year rolling periods. And then on top of that, there were simulations done for that data to randomize the returns to then generate, okay, here, if we have 1,000 trials randomized with actual return data from this time period, what happened? What was the highest withdrawal rate that we could have taken? What was the lowest withdrawal rate we could have taken and still succeeded? Now, of course, in this example, we have the benefit of hindsight. You don't have that when you're retiring, but it's still, I think, instructive to look at. So here, if you look at a 75% equity, 25% fixed income portfolio, the starting withdrawal rate ranged over the worst 30-year period in order to have a portfolio value at the end of 0 or greater was 3.7%. Right, this is assuming a fixed real withdrawal method. Over the best 30-year period, you were able to take as high as 6.1% in your first year. That's a huge difference. So if you have $1 million and you happen to retire in the best time period, where the 30-year window is going to be your best, you could actually take out $61,000 in the first year and then increase it for inflation every year thereafter. We would never recommend that. Whereas in the worst, you would only be taking out $37,000. Ironically, if you think about it, the worst time periods to retire are oftentimes at the end of a bull market, right? If you retired in 1999 or 2000, you were feeling really good. Your portfolio value was at all-time highs. The market was going gangbusters. Turns out you actually wanted to be extremely cautious there because valuations were so high. Whereas if you retired at the end of 2008 or middle of 2009, you'd probably feel pretty scared, but it actually turned out, looking back, to be one of the best time periods to retire because valuations were so low and forward returns were so high. So it's almost like the last thing you want in retirement, but you almost want to go against the grain of, you probably should feel more confident if you're retiring after a period of negative returns, right, in the market. As counterintuitive that is because the market tends to mean revert and forward returns are likely to be better. Clearly, the results show that one period's, result period of this during this section of time doesn't translate to the next period. And that's because, like we just saw in 2022, inflation, the inflation picture can change, stock valuations can go up and down, interest rates can go higher, making bonds more attractive. So there's all these moving pieces and variables which feed into what the appropriate withdrawal rate is. Now, I do want to note, because this is important, that a 4% withdrawal rate, that 4% rule, which is why it's called that, it did succeed. It did succeed even in the most difficult of times, right? In actuality. So if you were to follow the actual sequence of returns historically, the 4% rule does succeed. However, you can't, history is not going to repeat itself. So it's still reassuring, but when you introduce Monte Carlo simulation, which is looking at 1,000 different possible return combinations over that time period using the same data, it showed, while not a high probability, there was a realistic probability of failure, under 10%, but still it potentially could not work. So I think that's an important caveat, and that's why it's a rule of thumb and not a rule. So looking forward, Morningstar, I think, does a pretty good job. They did this at the end of 2022, but they updated kind of forward-looking return assumptions based on current inflation levels, interest rates, and equity valuations. And so you can see here the various kind of 30-year expected return, which is largely in line, frankly, with 30-year historical returns. But again, in retirement, the standard deviation or the volatility of those returns matters much, much more than in the accumulation phase. You can see the volatility can still be quite high. And then in bonds, this is really the biggest change. It was 2 to 3%. Now it's 4.5 to 5% yield you can get on fixed income. And then cash, 2.5, 3%. And then inflation bumped up from 2.2 to 2.85%. Again, this is looking out 30 years. So it's always going to be a bit of a moving target. And here is, I think, one of the most comprehensive charts that we looked at, because it's forward-looking based on kind of data as it stands today. And what the assumptions, the kind of the parameters are, is it's looking at a safe starting withdrawal percentage based on asset allocations. Again, there's 10 different asset allocations here, over whatever the window is, 10 years, 20 years, 35, 40 years. And assuming a 90+% success rate, okay? Which again, when you factor in Monte Carlo analysis, is pretty, again, it's almost impossible to get to 100%. So 90+% success rate is still very strong. And so some things to note, and where we put red dots is kind of most people's retirement time horizon is 20 to 30 years. And you can see kind of a balanced portfolio of 40 to 70, even 30 to 70 supports the highest initial or starting withdrawal rates, okay? The highest starting withdrawal rates. In fact, if you wanted to assume 25 years, if you were in this 40 to 70% range of equities, you could pull anywhere from 4.2 to 4.4 using that fixed real withdrawal method. So that's pretty material. Now, of course, if you've got 30 years, you have to drop it a little because it's got to last 5 more years, but it's still fairly compelling. Importantly, the chart does not consider ending portfolio value, which on average would be lower the less you have an equity allocation, less you have in equities. Over shorter time horizons, 10 to 15 years, high bond allocations actually supported a higher withdrawal rate, right? So here you're like 190% bonds, right? This is the equity portion. And over 10, 15 years, you can see you're taking out anywhere from 6.5 to 10%, which is a higher sustainable rate than what you see here with higher equity allocations. And again, we think it's important to remind you, this is somewhat conservative because most retirees do not have a 30-year time horizon. And secondly, most retiree spending decreases later in retirement as kind of they slow down and don't have the same activity level and energy level. And third, again, the idea that somebody is going to continue to spend more and more in retirement as their portfolio goes lower and lower under a poor sequence of return scenario seems highly unlikely to us. We would caution them against it. Now, on the other side, I do think that there's a risk, and we saw this in 2022, and this is something I think it's so important for everyone on this webinar to understand, which is if you vary your equity allocation greatly in response to what's happening in the market, it can have perilous effects on your retirement picture. Okay, and we saw this, I wouldn't say, certainly not the majority, not even half of our client base last year, but enough that it's a good reminder that when the market is performing poorly, and we have only had really a year of poor market performance. It was very poor, but it's only been a year, right? And that's enough to start to shake people out. That the idea that you're going to hold on to this equity allocation over a 30-year time frame, irrespective of what's happening in the market, is just not very realistic. Okay, which is why it is so important in our mind to, one, get your risk tolerance right as we can at the beginning, and to not get over our skis, right? We want you to be able to be in a portfolio that you can stick with through thick and thin. Because if you start out with the higher allocation side of equities, higher than you really can tolerate, and then a 2022 happens and things are down 15, 18, 20%, and then you sell out or greatly reduce equity allocation, what have you done? I mean, it's the worst. It's the worst possible scenario from a finance standpoint. You've essentially experienced all the drawdown of the equity markets, right? But you're not nearly as likely to experience the upside because you changed your allocation at an inopportune time. There are times where people do that and it's fine, because they're not taking anything from their portfolio, or they're taking well less than 3%, and so it's really just a function of them being able to sleep at night. But it makes our job very, very difficult, because it's really hard to know what is the asset allocation that a client is going to be able to stick with when times are tough. And until they're going through it, it's really, really hard to know that. So we're working on ways to kind of make that process better, to better assess what that risk tolerance is for you. But I just wanted to add that in. Over a 20-year time frame, you can see here, starting an initial withdrawal, if you're retiring in your early 70s or even 70, it's not inconceivable that you could take 5% or more as an initial starting value and increase that by CPI. This is showing there's a very high degree of success over this time period for that. Okay, so you remember the alternative methods that I mentioned to withdrawing money. What we've talked about so far is the fixed real method. Okay, and that's where, if you're looking here, this is over 30 years. This is a balanced portfolio, 90+% success rate. Initial withdrawal rate was that 3.8%. Okay, these other methods of withdrawal offer more flexibility and are more sensitive to what's actually happening with the portfolio in the market. And one of the most interesting ones, I think, to look at is this guardrail strategy. The guardrail strategy is one that says we're going to take a certain amount out to start, but if the portfolio goes down by a certain percentage, we're going to reduce that amount for the subsequent year. If the portfolio goes up more than a certain amount, we're going to give a substantial pay increase the following year. And with that additional flexibility, what the study showed was that the initial withdrawal rate that you could take from your portfolio, if you're going to use the guardrail strategy, was actually north of 5%. So there was a lot more money that you were able to extract from the portfolio over the life of a retiree by being willing to be dynamic in your withdrawals as a function of what was happening in the portfolio over the preceding year. Okay. Now you'll also notice, this is a little bit more complicated, but the volatility or the fluctuations around the actual withdrawal amount that you're getting, okay, this is showing in year 30, the standard deviation of the guardrails was like 35%, right? Because based on what happens in the portfolio, it could be much higher or much lower than kind of an average. But because of that, it allows you to take a lot more out early on, which for a lot of retirees is appealing because that's when they want to do the majority of their spending. And then you can see here, the forego inflation, that's after a negative returning year. You just don't take the CPI increase. That allowed you to take, well over 4%, 10% reduction in withdrawals following a negative year resulted in roughly 4%. And then the inflation haircut, that's basically the CPI minus 1%, again, allowed you to take north of 4%. So these introduce flexibility. The RMD is a pretty high withdrawal rate initially, but again, very high level of volatility because it's always based on the preceding year-end balance. So the fixed approaches result in more stable cash flows, but lower starting withdrawal rates, whereas the guardrails and RMD approach maximize the starting withdrawal rate, but can result in volatile cash flows on a year-to-year basis. That's kind of the summary of this. So this is looking at in year 30, what's the standard deviation around the withdrawal amount that's being taken out based on withdrawal method? Well, as I said before, the fixed real method, there's no standard deviation. Inflation haircut, there's none. It's, from day one, this is what it's going to be. And then there's a slight amount of variability based on the 10% reduction or the forgo inflation method. And the highest level of volatility is when you are in the guardrails and the RMD method. And this is where I'll talk about this a little bit later on. But we believe that as much as possible, if you can have your discretionary expenses, things like travel, home improvements, new car purchases, things that you have discretion in terms of the timing and the amount, if we can have a section or a portion of your portfolio where we're using the guardrails, the RMD approach for that, and as much as possible have Social Security, your pensions, and the other portion of your portfolio using something like a fixed real or one of these, we think that that's kind of the best way to manage kind of the risk and the sequence of return risk while kind of still helping you meet your goals, right? So it's just, we want to, as much as possible, map kind of the returns we can get from the portfolio to what your spending is going to be. And returns from the portfolio are inherently going to be more up and down. And so to the extent we can map that to discretionary expenses that also can go up and down, that's ideal, okay? It's when that mismatch happens that there can be a little bit more of an issue. So again, this is the starting withdrawal rate % by method and equity allocation. So here's all the different methods. Right, the fixed real, that's the 4% rule, which right now is actually showing 3.8% for kind of a balanced portfolio as your starting withdrawal rate. 10% reduction knocks you up to, for a balanced portfolio, starting withdrawal rate of 4. If you're willing to forgo inflation after negative years, goes all the way up to 4.3. The guardrails, as I mentioned, give you the highest starting withdrawal rate. Right, so it really allows you to maximize your spending. If legacy is not as much of a concern for you, and you really want to enjoy your retirement and stay really active and just basically say, I've saved, this is my money for retirement, I want to spend it as to its fullest extent, the guardrail strategy is going to be the way to go. RMD strategy, again, fairly high. Starts lower, but then the percentage goes up over time as life expectancy goes down. And then the inflation haircut, you can see also at about 4.3% for a balanced portfolio. So I think this is a good summary that was done based on a variety of different allocations and based on the method, what is for over a 30-year time period to have a very high degree of success, what's that starting withdrawal rate that can be taken? And these are those amounts by method. All right, now what we haven't talked about yet is the median, kind of the ending value of the portfolio after 30 years. Right, so far we've just looked at how much can be taken and what's the volatility around the cash flows. But this is the median value ending value at year 30 in millions of dollars by withdrawal method and based on the asset allocation that you held. And it assumes you held the same one over the course of retirement, which again is unlikely. But you can see, you know, if you had a 60 or 70% portfolio, you did the fixed real method in a, you know, not the best, not the worst, but kind of middle of the road, kind of might surprise you, but after 30 years, you'd be leaving behind 2.3 million. Okay. If you had 70%, you'd be leaving behind 3 million. 50% leaving behind 1.9 million as a median. And you can see as you go to the strategies like the guardrail strategy and the RMD strategy, where you're withdrawing more initially and probably more over the course of retirement because you're kind of extracting more from the portfolio when it's doing well. The trade-off is what? That you're probably going to have less at the end of life. So here at a 50% allocation, you're dying with 800,000 after 30 years. And that's a nominal term. So it would feel like even less than that in inflation adjusted amounts. RMD is probably the most aggressive and that there's the least amount. And that's the whole point of RMD, right? The IRS came up with this with the idea to purposely get money out of the account so that they could collect taxes. So that's going to have the lowest terminal value. And then inflation haircut, you can see the numbers there. So again, the problem is people don't really care about the median. They care about, well, what if it's the worst case and it's me? And of course, this is not showing that. But you do know that with the parameters of the study that was done, that after 30 years, there's a 90+% chance that it's more than zero. So you do have that kind of as a built-in part of the framework. So median ending value after 30 years is highest using the fixed real, 10% reduction, or forgo inflation methods and inflation haircut. So if your goal is to kind of leave a legacy, you'd want to look at, I think, either the 10% reduction, forgo inflation, or the inflation haircut method. It still allows you to take money out, but it's balancing that with what's the value going to be at the end of life. So spending method summary. So what's interesting about this is it's not just looking at the starting withdrawal rate, it's looking at the lifetime withdrawal rate, which is essentially like the internal rate of return of your portfolio over retirement. Like what have you taken out on average per year in real terms from the portfolio over the life of your retirement. And what's interesting here is the guardrails approach rate. The starting withdrawal rate is 5.3, which is great. But the lifetime withdrawal rate is less than that, right? It's 4.8 because in years where things are down, you're taking less. Whereas the RMD start is lower, but over the course, because you're taking more and more over time, you're basically draining that account out. So your lifetime withdrawal rate is more like 5.4%. And then you can see the other strategies that tend to be a little bit more conservative. You know, the lifetime withdrawal rate is 3.7 to 4%. In addition, you can see if you want kind of a set paycheck amount every single month, then you're going to want very little standard deviation. And so you're not going to want the guardrails of the RMD approach. You're going to want something that's much more kind of regimented based on your cash flow needs. And you can see here the median 30-year ending value of all these strategies compared. So the inflation haircut and the fixed real were both at 1.9, 10% reduction, and forgo inflation were 1.6 and 1.8. And then the guardrails and the RMD had a much lower terminal value. So again, depending on what your goals are, there's always trade-offs. If you want to maximize withdrawals over the course of retirement, then the guardrails and RMD approach are going to yield the best outcome. The trade-off is higher volatility of cash flows and lower ending value. If the goal is to really leave a legacy and have consistent retirement income paychecks come in, then you're going to want one of the other strategies, the 10% reduction, forgo inflation, or inflation haircut. And again, right, those are all a function of you're taking out a certain amount initially, you're increasing it by CPI every year, unless the portfolio has a decline in value. And then you're either forgoing inflation for that year, or you're reducing the withdrawals by 10%, or in the case of the inflation haircut, you're just, whatever CPI is, you're doing 1% less than that in terms of what you pull out each year. We also need to factor in taxes, right? So all these studies are kind of ignoring taxes, but to the extent distributions are from IRAs or 401ks, those distributions are going to be taxable. And so if you're pulling all of your monies in an IRA and you want to use this, and you're just say, I'm going to start 3.8%, or I'm going to do 4% because I'm 70 and I'm not going to live past 90. I want to do 4 or 5. Remember that those withdrawal amounts that come out also need to pay the tax liability. Okay, so if you're in the 25% bracket, you're taking out 4%, you're actually only be able to spend 3% of that. And so that really highlights the benefits of having Roth accounts, Roth IRA accounts, where the distributions can come out tax-free, and the benefit of non-qualified accounts. Because non-qualified accounts, while they may have a large amount of embedded gains, there's some level of cost basis in there. And so when you sell those positions, it's going to be a more efficient way to take the money out, because some of it's going to be a return of basis. And to the extent you have a gain, you have the opportunity to have it taxed as a long-term capital gain, which for most people is going to be at a lower marginal rate than their ordinary income marginal tax brackets. So just coming back to the importance of kind of trying to match guaranteed income sources with fixed expenses versus portfolio income. And we know that this can't be done all the time, but it's a good framework, right? So we want to try to match fixed needs-based expenses like your utilities, your liabilities, property taxes with guaranteed income sources, right? Because we know that the asset is matching up with the liability. So Social Security income, for example, if that can be used to pay for a lot of fixed retirement expenses, and you can have kind of just your discretionary portion, like your travel and the gifts you might want to do for kids or grandkids, kind of more linked to the portfolio, we think that that's a really, really good strategy. To the extent you can pay off your mortgage before retirement. Again, the common wisdom is, if the mortgage rate's low enough, why would you pay it off? Well, if you have enough money, that's fine, right? And there's I think financial logic to say that makes sense. But as we saw from the first couple slides, because portfolio sustainability is so susceptible to sequence of returns in retirement when you're taking money out, having as little as possible in fixed expenses when you go into retirement is really helpful. So if let's say you only are going to get Social Security in retirement, everything else will be based on your portfolio, which is in stocks and bonds, trying to pay off your mortgage before retirement can dramatically help reduce your reliance on portfolio returns, because it lowers your fixed monthly expenses, right? So we want as much as possible to try to match portfolio withdrawals with discretionary expenses, because that will protect portfolio longevity. Another asset in retirement that doesn't have a quantifiable value is flexibility, right? Being able to be flexible. If you have a home and you say, yeah, I'm going to live there for the first 10, 15 years, but there's a good chance I'm going to downsize or move to a lower cost of living area. Or I have 2 homes, but by the time I'm 80, I'm not going to want to have both those. I'm going to consolidate into one. Having that flexible mindset is a huge asset, right? It's a huge asset because it allows you to respond to what's happening in the real world with the actual market, and adjust kind of your cost footprint, your lifestyle to reflect kind of the reality of the situation. Choosing the right spending strategy will depend on obviously each individual situation, particularly the extent to which fixed expenses are covered by non-portfolio income sources. So I think we should have some time for questions. I don't know. I see the questions up. I don't know, Jeff or Jamie, if you've had a chance to read them, or you want to read, if they've been addressed, or you want to read them out loud for everyone's benefit.
Yeah, I can go ahead and read them for you. The first question was going back a couple of slides where we looked at the various withdrawal strategies and the terminal value of the portfolio. The question was, what is the starting portfolio value in those examples?
1 million.
1 million. Okay.
Good question.
The second question is, if we're talking about the guardrail approach, how do you start, or how do you pick the initial withdrawal amount and then subsequently kind of adjust for the upper and lower bounds of the guardrails?
Like this, the specifics of how the strategy works.
Yes, exactly.
I have to look at the study to get the exact amounts, but essentially you're starting at that 5.3%. If you want to use 30 years, 90% success rate, it'll be starting at 5.3%. And then the way it works, and I got to get back to this, whoever this is, the question is, whoever asked the question with the exact amount. But basically, let's say in the first year, the portfolio is up 15%. Well, now if they take the same dollar amount out, if it drops by a certain percentage relative to that initial withdrawal rate, you can take 10% more that year. Whereas if it goes the other way and it drops by, or the withdrawal rate increases by 20% relative to the start, you would have to decrease the amount you pull out the subsequent year by 10%. It's something along those lines, but we can, if you're curious, we can get into the specifics of exactly how and you can customize it, right? It doesn't have to be exactly what the study did. We could modify it so that the substance is the same, but we tinker with the upper and lower bounds.
Right. Okay. And I would just add, maybe that's kind of the importance of going back kind of periodically to the financial plan, just making sure that, we're never getting too far above the upper bound.
Absolutely.
The next question is from the same individual. This seems to assume spending equals withdrawal. How should required spending be taken into account?
Can you repeat that?
Yeah. It says this seems to assume spending equals withdrawals.
Right.
How should required spending be taken into account?
Well, so that goes directly into the financial plan, right? Here, you're spending the withdrawals, but this is not accounting for any other sources of income you may have. Like if you rent out real estate, you have Social Security or a pension. So obviously that's income that's going to come in that may be allocated to other spending. So this is purely looking at the spending from your portfolio assets. I think that addresses the question, but I'm not 100% clear on the question. I don't know if there's a way to reword it.
Yeah, Joe, if that doesn't answer the question, we can follow up separately, or you're welcome to retype in a clarification.
Yeah, we're going to do more on this. We're going to continue to do more on this. There's a lot of just a ton of research coming out about a lot of thought leaders who write about this, and we think it's an area of high interest amongst clients, and frankly, one of my favorite webinars that we've done a long time to research. So I really enjoy this stuff. I think it's incredibly important, and I think it's very practical for our clients who are in retirement or near retirement. Luckily, most of our clients are in a position where they can take, for a variety of reasons, they don't have to get close to that 4% level, or they're maybe taking 4 to 6% intentionally for the first 5 to 7 years of retirement, and then once Social Security turns on at 70, it drops down to 2 to 3%. So, it really is situation and individual specific as to how this all relates to you. But I still think it's really useful, just from a broad brush, way to think about, okay, what can I reasonably take here and not really have to worry about running out of money. And when we were talking about this beforehand, I think Jeff had the really good idea of saying, well, another way to do this is you could actually you could break your portfolio into two pieces, right? And you could say, okay, this portion of the portfolio I want to make sure is going to last beyond 30 years, 40 plus years, and it's the fixed portion. And so I'm only going to take 3% from that portion, right? Really start on the low and then increase it for inflation each year. And then the other portion, maybe it's 50%, maybe it's a smaller percentage, you could use something like the RMD or the guardrails approach, and that would be more mapped to your discretionary expenses, right? Things that you want to do, you love doing, but you're willing to be flexible year to year depending on kind of what's going on in the markets in your portfolio. So that's kind of a beautiful way, I think, of approaching this in real life. You don't have to pick one strategy. And there's other things, you could do, if you want to be more conservative, right? If we go back to those initial, where is it? These initial withdrawal rates over 30 years, right? You could say, well, I want to plan for 40 years, so I'm going to do 3.2%. But then, right, so you start there, but then you use a guardrail strategy beyond that 3.2%. So if the market does really well, the first few years of retirement, you're taking more and more each year. If it does less, you may say, you know what, I'm just going to leave it at the 3.2 because I already know that's conservative. So there's all different ways to slice and dice this to meet your particular needs. But now we at least have real numbers to work with here. So I really loved doing the research for this. Morningstar did some great work. Frankly, there's other people out there that have done a lot of good work on this. So I thank them. But hopefully you found this useful and it wasn't too wonky and in the weeds. I know there's a lot of numbers we're dealing with here. So if you have follow-up questions, please ask. But we really appreciate you attending, and we will see you. If there's no other questions, we'll see you next week. And let us know what you think, either in the chat box or send us an email. Let us know if you liked it. All right. I hope everyone has a good day and a good rest of your week. Take care.